Hello, all. Thank you for joining us today. We have Mr. Balaji GR, Head of Research and Co-Fund Manager, taking you through today's presentation. This presentation entails the exploration and discovery of corporate India, its performance, and how to evaluate it. This is a quarterly tradition at ithought. Without any further ado, let me pass on the podium to Mr. Balaji. Thank you.
Hey, thanks, Tarun. Thanks all for joining. Just give me a second. Tarun, can you just confirm the screen is on?
Yes, sir, it's on, sir.
Okay, thanks all for joining. As Tarun said, it's our, in terms of ritual, in terms of after every 90 days, Corporate India have declared the numbers. Our job is to put out the numbers, see the narration, where do we see positivity and where is the opportunity lies. So I think that's a broad idea. So disclaimers apart, right? This is more of one from an educative point and from a sectoral point and not a stock specific point broadly. Moving on to corporate India, it's evaluation time, right? It's always important, right? As a long-term investor, we keep looking at the most fundamental data, which is corporate data. And this is October, November, December ending numbers. So the four major things which we will cover in the next 40-45 minutes is one, the mega trend, which is governing this entire corporate India performance. Second, corporate commentary. Third, numbers. And then fourth, finally, the outlook of particular sectors. So the mega trend, which is corporate India, right? First is India. The very biggest mega trend happening for all of us who are very positive in terms of savings and coming into capital market is India's growth. And to put in perspective, right, for last 23 years, India has been growing close to 10% CAGR, which is a very significant growth vis-a-vis if you typically end up looking, the Western economy grows between 2 to 3%, and a lot of economies are even sub 1%, right? So given the nature of the world growth, when we do a nominal growth of close to 10, 11%, right, clearly reflects the underlying strength of what our economy is. And if you look at how we have grown over the last 23 years, right? So we were a 38 lakh crore economy, 2001-2. We moved to 87 lakh crore economy. As per the interim budget, we will become close to 330 lakh crore economy, right? So from our investing point, right, since you come for long term, that's what we encourage in ithought in multiple forms, both in PMS, in M2W, and so on and so forth. When India will become a 1,000 lakh crore economy, right, from 327 lakh to 1,000 journey, which will happen in next 10 years, right, roughly. How does we participate is the most important question which we should seek and try to capture it, right? Definitely in the interim, there could be a lot of noise, there could be a lot of pain, but the bigger trend is very clear, right? We are moving in the direction of a 1,000 lakh crore economy in next 10, 12, 15 years. And as an investor, how do we participate in this opportunity, create wealth for all of us? So that's a one singular objective for all of us as an investors, right? So having seen India, right, in very interestingly, when India grows, right, it also helps the corporate India to grow. And again, no better number than a 20-year track record. NIFTY earnings, which is a top 50 company in India, reported 12.8% CAGR. So you have India, which is growing at 10, corporate India is growing at 12.8. So I think this 10 to 13 is a very good range from a broad fundamentals point. And if you look at market, right, which is Nifty 50, which is a very good gauge of how over a long period people can expect what type of a return, is also delivered close to 13 to 14%, right? Clearly reflecting India as 10, earnings at 12.8, and market delivering 13.3. So the entire returns of the market predominantly come from the core underlying growth of the economy, leading corporate India delivering this 12.8% growth. So having seen India growth and Indian corporate earnings growth, now if you look at BSE-500, which is a very, a very refined universe, out of 4,000 odd listed company, right, this is a typical universe where our capital allocators or a PMS or MF participate for building a very high quality portfolio. And I'll tell you the relevance of this index. The entire aggregate market cap as on Feb end is 393 lakh crores. But if you look at only this BSE 500, which is, as I told, more than 4,000 is listed. If BSE 500 alone, value is 352 lakh crores. So by having this universe, we are covering 90% of the market. That's why when we say corporate India, we are covering BSE 500 because we are covering almost 90 to 95% of the entire market. If you look at the profitability for India, it's been always healthy. If you look at FI 6, 7, 8, 9, right? Corporate India used to deliver 4 to 5% more than the cost of money, which is basically when you do a business which is more profitable, that's where actually the stock price tend to go up, right, over a period because you're creating value. During 14 to 15, 16 period, this number got narrowed down. Obviously, right, our return on equity went down. But if you look at off late, which is FY 21, 22, 23, and even 24, this number is again going back, clearly reflecting corporate India does business, but they also does business with a profitability as a metric, which is not the case with many other countries, particularly, right? We know in many of the industries, China being a very large player. So we were in a couple of days back in a conference which is on China Agri Chem, and very interestingly, 40% of their ag chem companies have reported loss in FY23, right? Clearly, for them, profitability is a second metric, and it's all about scale is a primary metric. But if you look at India, say scale is a important metric, but profitability is even more important, and I think the numbers are reflecting. So having seen India GDP, corporate performance, and profitability, the one large mega trend which I thought it's very important for any long-term investor to see is this premiumization, where we are buying everything premium products in a big time. Obviously, the most vivid one is SUV. Today, if you read the commentary of Maruti also, right, which is a pioneer in small car, the biggest growth is coming from larger cars, right? And if you look at it on the right side, green tea, something I don't think 20 years back it was such a very relevant category. Today, this category is growing at a rate of 26%. Vis-a-vis the normal tea itself is growing at 9.4, right? So clearly reflecting India is evolving. India is becoming very aspirational. And I think certain data points like this only re-emphasize we are in a very bright economy where there is a young generation of population, and this population is very aspirational in nature. So I think we have seen the mega trends, what we thought we'll discover. Having seen the entire mega trend, now our time to switch over to what corporate commentary is about, right? So four biggest metric which we will keep tracking. The first is about Indian economy. So as an allocator of capital, we generally tend to be positive because that's where we can allocate into good business. But it's also important to see what the large corporates of India is commenting on Indian economy, and none other than SBI and L&T, the behemoth both in banking and in the infrastructure. So if you look at SBI commentary, right, the outlook of domestic activity is bright on account of sustained buoyancy in the service, consumer, business optimism, public spending on infrastructure. Unprecedented rate of infrastructure is happening, which used to be a 6 lakh crore infrastructure spend in 2015. Now we are spending close to 18 lakh crore, which is a 3x jump. Clearly reflecting India is building infra, and no better day than today, where we have opened that undersea metro tunnel in Kolkata, 4.5 kilometers, 4,000 crores project, clearly reflecting India is growing better, both infrastructure wise and the digital infrastructure wise, right? And if you look at L&T, right, a very similar commentary. The fundamentals of the economy is very healthy. Both corporate balance sheet is good, banking balance sheet is good, growth is very, very sustained, right? Clearly reflecting in the midst of a very, not a very favorable global environment, both from growth, inflation, political angle, and geopolitical risk. I think India is definitely in a sweet spot. I think these two commentary just re-emphasize what we consistently believe, right? Having seen the very great news, right? Obviously, there are pockets where, at least for time being, the growth is very muted, which is rural economy. Again, no better company than HUL and Dabur, which can comment very clearly how rural economy is functioning. And if you look at HUL commentary, due to lower agriculture yield and uncertainty of future crop, rural consumer sentiment is slightly subdued. Certain parts of the market recovering faster. So basically for them, urban is growing better than the rural. And I think The general belief is next 2 quarters things should become little okayish, and then the growth should revive. But having said this, this is a window of opportunity. If you are a 4 to 5 years investor, right, this slowdown is generally temporary, right? And as the economy grows, the cash flow moves back to rural economy when we do infra, right? And clearly, the window is open for any investor with a 4 to 5 year perspective to find great companies, which is very rural dominated, going through the pain, valuation is corrected, free cash flow yield is a little better, and finally, when growth revives, that's where we end up making above average outcomes. And if you see one company where rural growth is slightly better than urban, and a very interesting comment is, for us, rural growth is in the range of 6.5 vis-a-vis urban of 3.8. But the rural is growing out of their own initiative of expanding the network, which is basically getting more distributors, sub-distributors, initiative at the ground level to grow the growth. So instead of talking the broad things, when the entire aggregate economy is not doing, which is in rural, our objective as a capital allocator is to find companies which is doing their own initiative to grow better than what the aggregate, right? So this is to slightly contrast to what HUL, where HUL is reflecting the entire pain, but Dabur is growing better because of their own initiative. So these are two data points for us to think about. So having seen the economy and the rural, the one unique issue during the quarter came up is the Red Sea, right? I'm sure we have seen this term being used. When we looked at the entire 650 con call analysis, which we do using our ithought bot, very interestingly, close to 150 plus companies spoke about Red Sea issue, right? So clearly, when you look at numbers, which is the next segment, very good companies lost sales because of this issue. They lost margins because of the cost got escalated. So in this context only, we need to look at the Q3 numbers. And if you look at certain commentary, right, the Red Sea escalation proved to be a dampener. A lot of volume got lost and they lost even time, right? But slowly the problem is getting resolved. Even Tarsan product is commenting the similar. They're saying exports continue to be challenged right from US inflation, then war, then Red Sea issue. So something or other coming up in a global context. Again, every pain point can turn to be an opportunity in the medium term, right? So companies which is going through this pain point, eventually at some point in time, as the pain subsides, they'll be able to report better top line leading to better profit, cash flow, free cash flow, higher dividend, and improved return on equity metric, right? Which is what will give a very higher sustained price. So I think all these pain points, if for certain pain points are temporary, right? This could be again a very good window to find a very strong export-led company taking a hit both at demand level, at the profitability level. But I think in the medium term, I think when they come back strongly, right, I think market will appreciate them. The last one is exports. I think again, right, this is one important area because India roughly out of 300 lakh crore economy, right, 20% is exports, and exports being a subdued during this year. Again, Bajaj Auto being a bellwether in two-wheeler exports with TVS, right, clearly saying it's uncertain. A lot of inflation has hurt. In few of the country, the dollar availability has been an issue. I think slowly it's getting resolved. And a very similar commentary is coming out of Godrej Consumer, right? So if you look at one clear, right, India is very, very buoyant, and world economy from Red Sea and export commentary is very clear, right? It's not in a great shape. So that also reflects why India will continue to attract a lot of long-term capital. India can trade slightly premium to the world market. Why? The clarity on growth, not only for FY 24-25, you can talk FY 25, 26, 27, 28. I think there is a very reasonable confidence on the growth path and the growth trajectory, right? That's where we have to see where are we in the economic cycle, which we believe we are in the early to mid stage of economic cycle. And that's what the market is also reflecting from a overall trajectory. So having seen the mega trend, having seen the commentary, now it's our turn to see how the numbers of corporate India has been delivered. So the first and the foremost is the sales, right? So if you look at the biggest driver of value for any corporate, that has to come from sales. Because the moment sales grows, every other cost is a function of a sales. So then the profits comes back, right? So if you look at the grand total of sales, which is growing at 7%. So corporate India, which is BSE 500, reported roughly 37 lakh crore of a sales growth of 7%. But I double click it, right? So one of the notion which at least a good section of investor today carry is small cap tend to grow very fast, large caps are doesn't grow or they grow very subpar. But when you look at data, right, at least data is giving a slightly different picture. Large caps are growing, mid caps are growing. Aggregate small cap did not grow. Obviously, when you double click, segment of small caps are doing extremely well, but you have to accept that segment of small cap is also not doing well, right? That's why aggregate small cap sales growth is -3%. So, but overall corporate growth is only 7. That is what we are reflecting, right? We are entering into a phase where post-COVID economy has recovered. From here, it's a heavy lifting economic growth because the base is reset very high. So from here, growth will be the challenge, and any corporate which is going to grow above 10, 12, 15%, right, will be handsomely rewarded in the market, provided the starting valuation is palatable. But currently, I think most of the segment, right, valuations are not that juicy, which used to be 3 years back. So having seen the sales, if you look at sectors, right, we look at sectors both from two division. One is deep cyclical, which is very, very sensitive towards economy, and shallow cyclical, which is slightly less sensitive towards economy. The growth came from cyclical sectors, right? So if you look at banks, which has shown tremendous growth, oil, which is the largest by sales, is a flat. Automobile has been a rock star. Both two-wheeler did extremely well, passenger did extremely well. Commercial is muted, tractor is down. So that's a sum and substance on auto. Infrastructure is firing big time. And if you look at metals, been pretty flat, right? So one sector which did not do well in deep cyclical is chemicals, which is very clearly reflecting the pain point in chemical, which is what connecting back to the global slowdown and global recovery, which has been very, very patchy. If you look at shallow cyclical, right, I think the sector shined is healthcare. Clearly, in healthcare, domestic is growing close to 9 to 10%. The surprise factor came from US. Most of the company reported a very healthy non-India growth. And if you look at two sector within the shallow cyclical, which is FMCG and IT, had a very, very subpar. IT due to export-led slowdown, and FMCG due to rural, which we already shared the commentary. So primarily the growth came from cyclical, which is a slightly, I would say, low quality growth, right? Because they tend to swing a lot. When we get a high quality growth, which is a very stable business, the market tend to sustain far higher. So having seen the sales, right, now let's look at PAT, which is a primary driver of long-term return, and which is very, very healthy, right? A 19% growth for the PAT. Again, if you look at the growth came from large cap 23, mid cap 5, small cap 6. Very interestingly, this quarter is all about margin recovery. I think most of the corporate got good margin recovery because of their input material has been subdued. If you look at small cap, the top line is -3, but the bottom line is +6, clearly reflecting the recovery of the margins, right? If again double click a little more color on this 3.34 lakh crores of profit, one of our large cap or a mega large cap, which is TrueBlue, out of this BSE 500, we have invested close to 23 company. Look at the way we are trying to capture. BSE 500 itself will capture 95% of the profit pool of the country. And within that, our 5% of our TrueBlue portfolio captures 1/4 of the portfolio, right? So anyone who's looking at a very large cap, that's what our attempt in our mega large cap product called TrueBlue, to capture the best of profitable companies out of Nifty 50 universe. If you look at the furthermore division of this 3.34 lakh crores of profit, again, right, banks, which has been consistently growing close to 17%, right? So the last 1-2 years, banks have not done well. I think primarily the large banks have not done really well. And there is obviously a reference that stocks have not done well. But if you look at fundamentals, right, banks are consistently growing between 15 to 20% given which bank we are referring. And given the outlook for the economy, right, one sector where will fully benefit out of India growth will be bank. They are very well positioned both from capital, product, distribution. I think this is one sector which might be in a very sweet spot at this point in time, given the fundamental and the valuation, and growth is there. Crude oil did a very heavy lifting of 31% growth. As I told, automobile being the star performer in the deep cyclical, the growth is extremely robust, close to 53. As I told, two-wheeler led the growth big time, led by passenger and then commercial vehicle, and then obviously tractor had a very subdued. Iron and steel, again, a lot of what to say, from a loss making or recovery. As I told, in deep cyclical, one sector has going through the pain, and I think the pain looks like will be there for a couple of quarters is chemicals, and numbers are clearly reflecting, right? Chemical sector aggregate growth, profit moved from 9,000 odd crores to 4,000 crores. So clearly reflecting the broad pain which we have been thinking and seeing it. If you look at shallow cyclical, right, again, the three major sector, IT, FMCG has not done anything meaningful, and healthcare had a very good growth. This is a very, very interesting way we look at data, right? In terms of, and I'll take a couple of more minutes to explain because this needs that attention called PAT growth count sector wise. So what this says is we take every sector, divide the entire sector growth into high growth and low growth, and then see the ratio. High growth for us is any company growing more than 10%. So you have two buckets, right? 10 to 20. Greater than 20. Low growth is 10 to 0 and less than 0. Why? Why this 10 is very important? Again, I go back to our first slide. India is growing at 10%. So we think company growing about 10% can be differentiated and seen whether the sector is doing good or bad. So I'll take the first example, healthcare. There are 45 company in BSE-500 is out of healthcare. And if you look at the number of company reported a very healthy PAT growth of about 20%, which is 25 company. And there are 3 company which grew more than 10 to 20. So 28 company had a very healthy growth vis-a-vis 17, which is 11, which has not grown at all, and 6, which has grown at a very suboptimal layer, right? So if you look at this metric, the number coming is 1.65. It means for every one company which did not grow well, healthcare had 1.65 companies did extremely well. It means it's a very healthy sector. Allocating money in the sector itself was very rewarding, right? Let's go back to finance. Another very, very healthy outcome, 2.67. It clearly reflects for every one company which had a subpar growth, 2.67 company had a very phenomenal growth. So when you have this type of metric, it's very important as an allocator of capital, we have a higher weight to the sectors because predominantly it was a sector tailwind has taken care all the company. Now you go to the complete contrast, chemicals, 0.4. For out of 42 company, right? For every one company which has not grown, only 0.4 company grew. So clearly reflecting a sector where even though you are a great stock picker, the sector is going through the pain and you have to either take the pain or having less allocation in the sector is far more desirable act. Very similarly in FMCG, right? You can see for every one company did not do good job, only 0.48 company did a great job, right? Again, the sectoral pain and not the stock specific pain. And I'll tell you one sector very interestingly, a very large sector, which is IT, 32 company, 1.13. It again reflects for every one company which did not grow well, there was 1.1 company did well. This is a perfect sector where if you can identify a great stock, you will be able to make money. Why? There is an equal dispersion of good outcomes and bad outcomes, right? So I think when we look into sectors, we see, is it a sectoral pain or a sectoral gain or a very balanced sector, and then see what contributed us. Is it our sector selection or the stock selection, right? So that's how the nuanced data can be seen for every sector reported by BSE 500. In some sector, the numbers are very, very high, right? It means every company did extremely well. Like infrastructure number is 2, right? Clearly, most of the companies are doing good, right? Very clear case. So having seen the entire profit in multiple dimensions by sector, by count, now let's see how many companies we have deep cyclical and what is the right. So what we do in this metric is there are 499, right? So NMDC still doesn't have both the quarters. They just got recently listed out of the spin-off. There are close to, or there are 70 odd company have reported 1,000 crores of profit, right? So clearly reflecting 1,000 crores profit is the number, which is a big number in India. And there are only 70 odd company reporting quarterly 1,000 crores plus profit. And if you look at the loss, right, 32 company have reported loss, right? So clearly this gives you idea about, even though BSE 500 is a big benchmark, it tells you there are companies which is 1,000 crores profitable. There are 34 company in deep cyclical, which is profit between 500 to 1,000 crores, and so on and so forth. So various segments will give you where how many companies are available, and then how is your portfolio is built, so that you have a very broad mix of a very large company, mid-sized company, and even a smaller company, right? The last data again to decipher how the top 50 is capturing it, which clearly reflects from an allocator of point. I would always recommend, right, our investors should have a very good portion in the larger ones. So if you look at Nifty 50, right, which is only 50 company out of BSE 500, but they capture 56% of the entire BSE profit pool. And the non-Nifty 50, which is close to 450 companies, capture 44%, right? So the top 50 is a very important company from a capturing the profit pool. And that is what our endeavor in TrueBlue, which is our mega large cap fund, which only invest within the Nifty 50. So having seen the entire profit, right, this is the final metrics on corporate India is how did both sales and the profit grew in the last quarter. So out of 499, if you look at this green box, what it tells is these are the companies has grown both the top line by more than 10% and profit more than 10%, right? And if you look at 86, which is on the right, close to end, right? 86 as a number, greater than 20 by sales and greater than 20 by profit. 86 company in corporate India, which is BSE 500, have reported more than 20% of top line, which is extremely healthy, and more than 20% of bottom line. If you look at 72, which is on the left top, these are the companies where both top line degrew and bottom line degrew. So we look at the data in multiple dimensions to see in some company, top line is growing very healthy, but bottom line is not growing. In some company, bottom line is growing healthy and top line is not growing, right? So I think mix and match will give us an idea where the current opportunity is available and how do you find a couple of more opportunity to allocate capital wisely to make money in the medium term. So we have seen the mega trend, we have seen the commentary, we have seen the corporate India number. Now finally, the last segment, which is again a very important segment. What do we decipher out of all these three is the outlook. The first one was the infra. I think, again, I told, right, no better day than today, where we have established our credibility of doing a underwater metro tunnel. L&T, this is L&T slide. Bemoth commenting growth is extremely good. And look at the capex, right? We used to do public capex close to 7%. Today, we are doing close to 8.3% of GDP, right? Clearly reflecting the thrust is to build infra, build growth sustainably, stable macros. And for a lot of our companies, even Saudi Arabia infrastructure projects are firing in cylinder. So a lot of our companies are getting benefit out of this, right? So clearly India infra is firing. The second is banking. As I told, banking is a very important sector for any investor, because if you look at every sector which is diversified index, 35 to 40% of the index is banking. And if you look at banking, right, the growth rates are close to 15, 16. India is growing at 10, banking is growing at 15, clearly reflecting a very healthy scenario. And if you look at sub-segment of growth, growth is coming from retail, growth is coming from agri and service. Industry growth is subdued. Why? Industry balance sheet is extremely healthy, but I think they are getting into capex phase, and I think this is a number which will improve in the next 3 to 4 years. If you look at a couple of names, right, I want our shareholders, our prospects to look at one data clearly reflecting banks are growing, which is NII growth or PPOAP, which is profit before the provisions. clearly operating profit, right? Pre-provision growing at a very healthy 15 to 20%, right? The aggregate private bank NI growth is 17%. So I think fundamentals of the bank is very, very robust. Obviously, one pressure point which is there, and I think it is very will be there for next couple of quarters is the deposit growth. But it's a contextual one, and I think we have seen in the past as inflation subsides and overall liquidity improves in the economy, I think this pain point should go away, and that will be very, very positive for the banks in the medium term. Having seen the infra and the bank, the third big sector where we are very positive, and a very, very good slide has come out from Reliance, right? If you look at 5G infrastructure, the last 1 year, significant infrastructure has been built out. And I think this picture really calls out the depth of our infrastructure built in terms of telecom, right? So from a business model point of view, the competition has gone down, investment is being done. I think next 3-4 years, the productivity will rise, and that will be very, very positive from a shareholder's point of view. Fourth, pharma. I think over a long period, pharma India is going to grow between 8 to 9%. I think Sipla has called out the biggest driver is one is lifestyle changes. Chronic ailments are becoming very, very large. A good portion of our society is also becoming old age, right? Which I'll share it in the next slide. And the pollution levels have gone up. I think clearly this is one sector where incrementally in next 5, 10, 20 years, the growth will be far more durable and far more sustainable because we are a young generation as of now. But as we move in next decade, I think this sector relevance will go up and the weightage of the sector is likely to go up in the medium term. And if you see this data, very interesting data on India population, I think the big thing is working age population is very, very large. I think that's a big positive. But again, if you look at old age population, right, we were 6.8% of the entire population was old age in 1991, moved to 7.5, then moved to 8.6, then moved to 10.1. In next 10 years, we're going to go to 13.1, right? Incrementally, this number is getting larger, and this will have a bigger influence on how much money we'll be spending in healthcare, right? That's where it could be an opportunity from an investing point of view. Last but not the least, wealth management. I think India is creating tremendous wealth. We are seeing, right, a lot of exits by founders in form of IPO and so on and so forth. And I think we are, as a house, we are very, very bullish on wealth. A very interesting data from Prudent. It's not a portfolio stock which we own, but interestingly, right, India is a very saving economy. We save close to 29-30%. So 300 lakh crore economy, 30% savings, and then the savings get funneled between public saving and the private saving. Then obviously, right, what is we'll save into financial assets. I think financial assets is going to play a very, very important role in next coming decades. And I think a lot of wealth management, asset management, insurance company, life, general, all this will benefit out of the entire savings pool, which India will do it. And the last one is on the consumer. As I told in the previous commentary, broadly rural economy is soft. But again, very interestingly, right, when the entire rural is soft, one way we can always find opportunities. Some states can do very well. And I think this data beautifully captures how GST revenue is growing at state level. And I'll share a couple of interesting data. If you look at Maharashtra on the west, aggregate India GST has grown at 13% CAGR in the 4 year. Maharashtra GST has grown at 15%, Haryana at 14. If you look at south, Karnataka at 15, Andhra at 14, right? So instead of talking the broad things, right, when the entire economy is not growing well in some pockets, the micro states can do well, and that is where the opportunity lies in. And if you look at the outcomes of consumer numbers, as I told, FMCG companies have reported a very bleak set of numbers, and no better than bellwether than HUL, which reported a sub 3% types of a growth. Only two company, which is basically premium food company, which is Nestle and Tata Consumer, had a more than double digit, and United Spirits, which is a liquor company. Paint again had a very subdued top line, but interestingly, as I told in the before, this quarter is all about margin recovery ex banks. Banks have actually had margin neutral or margin pressure, but other sectors had a margin recovery big time. And paint, if you see top line grew 5%, but PAT grew 45, clearly reflecting the lower crude price, lower chemical price, which needs them to build out the product is favorable terms. But going forward, sales has to pick up. Why? Margins till a point will come. Beyond a point, it's all about sales, and that's where this five has to go to double digit to create value to these long-term shareholders. And I'm sure much awaited Grasim entry has happened in this sector. This sector is entering into, in our view, the high competitive zone, and it'll be very interesting to see in next 1 to 2 years how the incumbent players are going to defend the market share, how the challenger is going to take on them, and see any good opportunity can open up, right? But this is a period to observe, not to venture it very fast, because the capacity created both by the new player and the incumbent is a lot more than the demand. QSR again a very muted growth, and discretionary primarily muted, except again one or two company like Titan and Trend did extremely well, right? So clearly consumerism is not firing in cylinders everywhere. It's very pocket led, but the opportunity is also right. There are few great company out here which eventually will come back because of their own strategy, their own product, and obviously economy reviving, right? So in the medium term, opportunity comes to companies which is going through a temporary pain, but permanently it is not a pain point, right? So finally, right, having spoken the four things about the mega trend, the commentary, numbers, and the perspective on some sectors, is there an opportunity at this point in time? And we see clearly, right? One of the best part is the earnings expectation of the economy, which is basically Nifty in this case I'm referring, but it's a broad idea, is very, very stable. And what this data suggests is typically in the beginning, the expectation will be high and eventually it comes down. But off late, as the economy is doing very well, the expectation is relatively stable. And if you look at FY25 EPS estimate for Nifty, which used to be 1080 in the beginning, now also is close to 1080, 1070 to 1080, clearly reflecting expectation is not going down. That's where whenever market is correcting, right, market is finding it somewhere, some stability, and actually bouncing back. If you look at subsegments where the growth is going to be very strong, one, banks are going to lead the growth in the next coming, not only FY25, FY25, 26, 27, 28. Banking will be a very, very primary driver. A lot of infrastructure company will drive the growth. If you see pharma will grow pretty well. And we see one of the assumption which we are slightly skeptical, and we will see a little more evidence, is tech. Market is today pricing in a 14% recovery in growth, which is baking in world revival, currency depreciation, productivity gains, and some more of demand revival. I think this will be tested in next upcoming 3 weeks, where the large corporate like TCS, Infi, HCL, everyone will report the numbers, and then they'll guide for next 1 year, right? I think this is one number which is very interesting, where the market is having a little more faith than our institution. But broadly, if you look at banks, a very clear trajectory of growth. The telecom will having a very high expectation. So, right, what does it reflects to us is get ready. ARPUs has to go up. Today, if you look at ARPU, right, ranging close to 200, Bharti leading the ARPU, and Jio is actually slightly lagging, and clearly reflecting in next 12 months, definitely price has to go up. Their return on equity is extremely suboptimum, and I think over the next 2 to 3 years, ARPU should trend higher, and that should be very, very positive from a telecom sector point of view. And finally, from a broad valuation, I think Nifty continue to trade very close to long-term average of 20 times. So that's where broad market is not into any type of a worry zone. Obviously, in the last few weeks, we have been hearing this noise, and I think we clearly concur in some perspective. There are pockets of market are very expensive, having high expectation on India. Some sectors are becoming a go-to sector only to invest without actually fundamental track record, right? Primarily driven by government demand, government regulation, but there is no business model, there is no free cash flow still now, but there is a huge hype out there. But broad sector wise, broad industry wise, at the aggregate index wise, I think we are in a decent zone. It is not the cheapest market, but it's not the costly market. So from an investing point of view, come with a 4 to 5 year outlook and come with a good reasonable expectation. I think definitely there is money to be made even at this point in time. So The sectors where clearly valuations are palatable, obviously, right? This is not our full view, but obviously it's a very interesting data from one of our institutions which serves us. Banks clearly, as I told in the commentary, earnings are very, very robust, not for 1 year, multiple years, and valuations are very, very palatable. There are a couple of more sectors we are very positive. One is insurance. Again, earnings growth is going to come back. So this blue round can get into green, and valuations are very palatable. So we do find few sectors where last 3 4 years been a pretty challenging period, and but I think next 3 4 years can be a very rewarding, and that's where our entire energy and time is getting allocated. To conclude, as I told, economy is in a good shape. I've shared enough data. Corporate is in extremely great shape. I think this is where the positivity in us is coming. But the challenge today is valuation in pockets are very good, but in pockets definitely a bit of slightly expensive zone. So we have to be very careful in terms of how a portfolio is constructed today, keeping a 4 year outlook and not a 4 month outlook, right? So to put in one of the evidence for our new account in our PMS, we are deploying between 30 to 40% given any fund, clearly reflecting we are cognizant of after 3 years of a bull market, we are deploying this capital. So we have to be very choosy. We have to go one step at a time, build a very robust portfolio in next 90 to 100 days. So the next 4 to 5 years we can compound and capture phenomenal growth, what India is going to deliver, right? As I started, I will end, right? We saw India moving from 30 lakh crore economy to 327 lakh crore economy. How when India will go from 300 to 1000 lakh crore economy, how well we can capture it. That's our whole intent. This is one interesting data before ending our session is how to think about return, because having gone through a big bull market in the last 2 to 3 years, it's very easy for all of us to think money making is easy and 15-20% is a given return. But I think when we look at data very dispassionately, the data doesn't support for a very long period, a 15-20 is an easy journey, right? So if you look at long-term return in India is between 12 to 13%. And again, I go back my first data, right? India is growing at 10, corporate is earnings is growing at 12 to 13, and India has delivered 12 to 13%. But in a short period, some of them can make 15-20. But I think over a long period, it's very good to see what is our economic growth. 3 to 4% above economic growth should be our ideal return expectation, right? I think that's what I thought I'll share this data. This data every month we put out in the public domain. It'll be very interesting for you to refer back to see how to anchor, how to think about long-term returns. So having shown the everything, my final slide in terms of how we have performed, very happy to report 4 flagship products have done extremely well in the particular genre. So Solitaire is a multi-cap. TrueBlue, as I told, is a mega large cap fund. Vridhi is a small and mid cap fund, and Spear is a multi-asset. Phenomenal track record in their own perspective. And one thing very common in all the 4 products is not only return. As a house, we consistently believe deliver sustainable return, also take lower risk. And if you see most of the product or all the product, right, we are close to 20 to 30% lower risk than the market, right? So our objective is to deliver sustainable 3 to 4% more value over the benchmark in the long term and also have 30% lower risk. With that, I would like to conclude the session. Thanks for your patient listening, and we'll be very happy to answer any of strategic question on sector. Try to avoid stock specific question because it's a forum to understand corporate India performance and sectoral thinking, and we'll be very happy to serve you. Thank you. Over to you, Taru. You can type the question in the chat. Just give me a minute. We will take up the simulation. So those who want have any question, you can type it in the chat window. Okay. First question is why government says GDP growth is 7 to. Okay. So there are 2 GDP, right? You have a real GDP and a nominal GDP. What I refer is the nominal because in life, everything is nominal, right? We earn money in nominal. So what is nominal GDP is? Real GDP plus inflation is nominal. So from an economic growth reporting point, countries has to report the real GDP, which is close to 6 to 7%. But when we look at data from sales growth or our income growth, our expenditure, right? When we spend money, everything is nominal, right? So that's where I said 10 to 11 is a nominal GDP. If you remove inflation, India's growth is 6 to 7%, which is real GDP. Hope that answers your this one. Next question, if everything is looking so good, super duper, one way up forward, is there no flip or failure possible? Is there only roses all the way, or we wipe euphoria? No pitfall. Okay, I think this is a very important question. I completely take this perspective. Economy is in good shape, corporate is doing good. It doesn't mean we have a straight return, right? It's our birthright. We invest today, tomorrow morning it has to go up. No, there is no one-to-one correlation between economy doing good, corporate doing good, and stock market is doing good, right? Not necessarily in the short term, but in the medium and the long term, this is a very important tool to create value. Is economy should do good and corporate should do good, right? So clearly, in the short, which could be 1 to 2 years, there is no correlation, and I think we have to clearly come with the 4 to 5 year outlook and not a 1 year outlook, because we are after a very extended bull market is what this conversation is happening. That's a very important question. There will be definitely swing factors will come. So you have to come with a 4 year outlook. You have to come with a reasonable return expectation. In our view, anything between 13 to 15% over a long period of time with a lower risk is a very healthy return. I think this is what someone should expect. Having we delivered very healthy outcomes, which is there in your screen, I think if we anchor there with a 4 year outlook, I think we are in a good position. Hope that answers your question, sir. 3 sector you have not mentioned: defense, hotel, airlines. I think these are not very large sector from a profit pool point. That's one. If you look at, I have mentioned the corporate India BSE-500, right? As long as it is there, it's there. If you look at defense, obviously it's gaining importance, but you see a very long track record, right? For a very long period, it did not do well. So I think over a period, definitely few companies will establish the credentials. When we have a good opportunity, we will invest. But at this point in time, there is no high-end tech defense company with an attractive valuation. That's one. Hotel, I think hotels business are doing extremely well. Yesterday also we went for an exhibition in terms of conference to see is the demand is slowing down in hotel. For our surprise, demand is extremely healthy. People are paying up. But again, the question is, today we are comfortable in a couple of names, but broadly we think the easy money in hotels is being done. Airlines, again, we don't have many company, right? Barring Indigo, which is a very credible large player. We don't have any exposure, but I think this is one sector which can reward provided you are willing to buy at a low point, but it's a very cyclical sector. But broadly, I think hotels are doing very well. The numbers are firing. But finally, right, it's not about fundamentals. If the valuation is capturing not only FY25, 26, 27, 28 year growth, any disappointment in between, I think the stocks can fall. So I think we have to be mindful what is factored into the price. It's far more important than the actual outlook. What should be the PE of a given a particular growth in earnings? I think it's a very tricky question. There is no one price to earning multiple. Primarily because there are some sectors which need a lot of capital. There are some sectors need less capital for the same growth, 10%, let's say 10% growth. Some company need the entire earnings to produce 10% of growth. Some company need 50% of their earnings to produce growth. Some companies like asset management company or a wealth company doesn't need any capital to produce 10% growth. So if you think about a company doesn't need any capital should trade high multiple, right? That's given thing. So how long they can grow and how long this business model can sustain will give you the multiple. But generally, I can tell any multiple above 100 all non-sustainable. People in the last cycle invested 70, 80 multiple companies where growth is peaking, ROE is peaking, and clearly seeing the pain point today where great companies underperform for 5 year period, not because of the company problem. We overpaid by paying a 70, 80 multiple with return on equity peaking and actually dipping down. So I think when we pay beyond 50, 60, right, you have to be very careful. The growth has to be about 20, 25% and ROE should be very stable and upward, right? Otherwise, it's going to be a trouble. but there is no single answer what P, right? There are companies which is trading at 15 P in the last 15 years also delivered zero return, right? So we can say 15 P very cheap, buy. But if they don't produce any earnings growth and they disappoint on capital allocation, investors are not going to make money, right? I think it's not a one number, but definitely the higher the number, we have to be very clear on the growth, profitability, business model, and sustainability, which is like 70, 80, anything like 40 multiple, right? A classic high quality FMCG company with a high free cash flow growing between 14, 15%. If you do a DCF itself, right, you are going to get a growth close to that high 40, 35 multiples. And that's what, if you see the long-term track record of great FMCG company globally also, or even in India, right, you're going to see a 35, 40 multiple as a number. Vis-a-vis infrastructure company or a zero free cash flow company, always tend to trade at low multiple because they don't generate free cash, eventually, which will create a lot of value. Hope that answers your question, sir. How do you exit a deep cyclical sector like bank? I think any deep cyclical, if your valuations, you are going to turn on the ROE profile and the earnings profile, right? And the valuation is still frothy. I think that's where you end up selling. At this point in time, we see valuations are very palatable in most of the funds where we can expose to banks. We are overweight in banks. Otherwise, any deep cyclical, you end up seeing where is the growth profile in the medium term, a return on equity profile, or the ROA profile based on which sector we are evaluating, and what is valuation is baking in, right? If valuation is elevated and then growth is going to dip, I think you have to think about how to exit. And exit is not a single call. Are you overexposed, underexposed? If you're overexposed, definitely you have to consider a lot more. If you have a minor exposure, you can continue to stay, right? Because illiquidity issues do come, right? If you are managing a larger funds. Hope that answers your question, sir. Like a power banks, all that. US seems to be recession going in. I think US seems to be recession in our mind. Look at US corporates are delivering good numbers. Markets are doing extremely well. I think economy is doing okayish. I don't say recession has come in. It's okayish, and I think they are anyway not going to grow in a rapid number, right? They are very large economy. They will grow between 1 to 2% over a long period of time. So I think we don't have to worry about US recession. All we have to see is political stability, how we are able to execute the growth, and come with a reasonable expectation, and don't go with a blind belief only small cap will do well, only this sectors will do well. 3-4 years back, an untouchable segment was PSU, right? No one wants to look at it. I think the big wealth got created, right? So I think there is no zero zone. Don't avoid it. Dispassionately look at data. So one of the way we institutionalize it, why we put out this presentation is how our decision making should be led by data and not by our past opinion, right? That's what most important, to be very dispassionate about our decision making. Hope that answered your question, sir. Market valuations of small mid cap are higher than historical, means return may be subpar. Historical return around 15, 18, 25 for last, hence. I think definitely we are at a zone where the next 3-4 years is going to be a little more subpar. We don't have a scope for re-rating. It's going to be a de-rating if at all. I think you should come with a lower return expectation, even though it could be healthy. This is where I think how your institution is going to behave, how you are going to come with capital in multiple point in time will help you, right? So investing should not be considered as a one-point decision. What we actively encourage in ithoughtPMS is you start with the 50 lakhs, but you should continue to deploy at multiple points, because then you can adjust your cost and then eventually capture all the gains. But definitely easy money has been made. From here, it's going to be a little more challenge. You have to be very, very cognizant on how the portfolio manager or the institution is managing the risk to deliver the outcomes. You said chemical hasn't performed. Do you see valuation comfort chemical? I think we are studying closely agri and other non-agri chemical valuations in some pockets. But there are two concerns primarily. One, lot of chemical companies still in capex zone, though capex is yet to commission. So there will be a huge pressure both at the operating level and at the balance sheet level, because few of them have taken debt. So I think we are seeing the evolving situation. Currently, we don't have any position, but we are continuing to monitor this situation. Some downgrades also is possible in rating because couple of company balance sheet is not in a good position. So we are waiting out. I was there in a chemical conference a week back in Bombay, met couple of MDs, and definite mood is couple of quarters still pain left, and then maybe we have to see how it will evolve. The data which you have presented in slide is available to public for analysis. I think these are generally, the video will be put out. I'm sure you'll be able to go back and see the video if you want. I think all this data is generally there in the public. We have put out in our own proprietary way, and I think this video will be out in a day or two. So hope that answers your question, Mr. Karthik. Our overall valuation should be considered with current interest rate geopolitical. What is the current risk reward perspective in overall? I think it's not a uniform answer. Risk to reward in large cap is extremely attractive. I would say deep attractive rather. In next 2 to 3 years, this is a one window is going to give a lot more money to be made with less risk. If people choose to allocate more money into small and mid cap, they should come with 2 criteria. One, come with a longer time frame, ideally a 5-year plus. Come with a mandate to invest in multiple time periods so that you don't invest at one point in time. Come with a reasonable return expectation, which should be close to 15%. I think if you have all these 3, you can deploy money even in small and mid cap at this point. Large cap, very attractive from a lump sum. You have a 3-year capital, a huge attractive window is open in multiple sector. Hope that answer your question, sir. What's your medium long-term view on fertilizer is climate change? We don't have a very active coverage. We do have bit of partial coverage in this sector. We will see at every point in time, we look at every sector where we need ROE profile improving, growth improving, and the valuation attractive. If it happens, we will consider. Currently, we don't have any exposure in fertilizer. Climate change, yeah, it can, right? Also, a couple of chemicals can be banned. So there is always this risk in any agri side chemical companies, right? Which can be having a repercussion from a regulatory point of view. You have to be mindful how concentrated companies are in terms of product specific. It was good. Thanks, sir. Growth in your slides for different sectors. How do you arrive at this? What was the... Okay, these are basically estimates from general consensus from the market. So you have India GDP growth estimates coming from budget. Then you have a broad estimates from the global agency and the rating agency. From that broad commentary, which we end up having conversation, right, in terms of with corporate. These are estimates. Obviously, these are not very sacrosanct numbers. These numbers can change. But broadly, you work with some assumption, right? Because investing is not about the past, investing about what can happen in next 1, 2, 3, 4 years and how valuations are reflecting and where the opportunity is, right? So these are not one point data. It's keep changing and we have to monitor it continuously. Why not this probability? Sorry, market with no growth, but just late number for 30-year period. I think with growth there, we might not have a very stagnant markets. Broadly, we think we don't have to go like a Japan, right? We are in a growth economy. You have to see where are we in the country, right? So when we go there, we will talk about it. I think we have at least next 10, 20 years where we will be a growth economy, primarily because of our population, right? We have a young population age, and that doesn't change in next 10, 20 years, correct? But if we mismanage the entire economy badly, any economy can become not only Japan, badder than Japan, right? So I think we have to take investing with a pinch of, it is not a linear return. It's you're having a view on the economy and the market and the perspective. You should come with a medium term. You should take 15-20% correction as part and parcel, right? Again, in last 3 years, what we did not see, which is not a very healthy scenario, is there is no correction. Corrections and parcel of market. Last week, we just had some bit of a correction, or this week, we had some bit of a correction. I think these corrections are very, very required. Even in a great bull market, we will have corrections coming up, right? Hope that answers. Thanks, sir, for your comment. Can you please tell us miscellaneous sectors like CDSL, MCX? I think broadly, again, I don't want to get into stock specific, but we are very bullish on financialization. So if you look at CDSL, BSE, CAMS, FinTech, right? It plays mutual funds, wealth management. But on all this sector, all this business, one thing very common, as I told, these are great business which doesn't need a balance sheet, right? They are high free cash flow. But the question is, where are we in the market cycle? How is the earnings growth in the next 2 to 3 years, right? If you buy a company which is making a lot of money based on F&O. And if you see the regulatory comment, right, they are very, very unhappy about the way F&O growth has happened in the economy, both in commodity market and in the derivative equity markets. If this company, something happens by regulation and the entire earnings goes degrowth, you will see an impact on the stock price. So the question of when do you buy this company? They are very, very cyclical in earnings, but they're very good at balance sheet. So you buy them when there is a depressed capital market, depressed mutual fund growth, and actually sell them when there is an euphoria, right? So we have to see the context, but these are good businesses, most of them at least. I would like to see free cash flow generated company sector wise. I think we will do once in a year. Free cash flow needs balance sheet, and if you look at full detailed balance sheet comes in once in a year. So maybe next results we will definitely put out, sir. Do you think infra growth and overall growth driven by state, private, still subdued consumption? Yes, absolutely. In the last 3 years, the entire predominant growth came from government, which is central, then state, PSU companies. Now private started. They are starting. If you see, steel companies are putting up their greenfield project. Power companies are putting up their mega projects coming up. These are two large sector which consume a lot of capital, right? A very capital intensive strategic nature, right? So that growth is coming back. Consumption will come back eventually as the economy grows, right? The money will flow back from corporate to public and public to consumption. So it's a question of a time, but definitely now as we speak, discretionary consumption is doing extremely good. Non-discretionary is taken impact due to primarily inflation. But that could be also an opportunity, right? If everything is firing, where do you invest? So today you look at sectors which is going through temporary pain, but eventually will come back and you invest into a good company and make money next 3 to 4 years. That's what our primary job, right? What's your view on electronic manufacturing? Again, a very evolving sector, a great growth. Business models are evolving, ROC profiles are evolving. Valuations definitely not in a zone to buy. We have one company which had spinned off their subsidiary which got listed, but we don't have any active exposure in EMS. But I think a very interesting sector to observe, learn, and maybe at some point in time we will consider it. We have daily the positive change in outlook, foreign flow and capital. Do you expect any PE re-rating happening in a broader index? I think PE re-rating all we should not expect. We should expect only earnings-led growth from here. Enough of PE re-rating, I think, in our view. Can you please explain why you are expecting 50p company had to grow 25 hours the relationship? So PE is a function of growth and the cost of money and the free cash flow generation, right? If you do a DCF, I think how much of dividends are going to grow and what's the cost of money and how long you're going to grow, all that will give you. That's where growth will become a very primary driver if we are paying a 50, 70, 80 multiple times. Particularly in the context of shift in green energy by all large players. Yes, I think green energy, globally, if you study, it's good to the society, sometimes not great to the investors, right? Because what we primarily focus is the demand side. But interestingly, you have to see the supply side, right? So I was going through again one of the large report out of China, right? The supply side economics in some of the sectors are very, very bad in terms of huge capacity got created by these sectors globally, and huge pressure is on the every other country. So we have to be very mindful rather than getting very excited on demand side. If the supply side economics is not great, how do you expect who will capture the demand in next 5-10 years, right? So that's a challenge. We are not here to capture every growth, but we are definitely cognizant. Green energy will be growing faster than India. So this is one sector where we are paying attention, but we see how do we pay. So if you look at, we might look at a couple of bearings company, which will do an offshore wind energy, which needs bigger bearings, right? So you will find different way to capture the green energy, green growth, rather than straight away buying a wind turbine company or maybe a solar panel company, right? So it's about how do you capture the growth and sustainably where we make money, company making money and then shareholder making money, right? Because story can take a company to a point. Beyond a point, if the company doesn't grow the sales, grow the profit, free cash flow, story falls. And we have seen in the past enough of the stories which is good at point in time and eventually blows out, right? How many factors? Which major factor in Indian economy depends on what happens if it is? Did we consider factors while investing? I think when investing, Indian economy, right, the growth comes from basically population growth of 1 to 2%, productivity growth of 5 to 6%. So your real GDP 6 to 7, and then inflation of 4 to 5, nominal GDP of 10 to 11. That's how the India growth is baked in, right? But beyond that, it's all about bottom up, right? You find a company from an allocator point. If you ask me, 80% of our time is spent on find a company which has produced a great product, loved by all of us, selling well, sales leading to profit, profit to cash flow to free cash flow, more dividend. I think it's a perfect stock which will create value, right? And you just go back to Apple. Apple got good products, sold well in US, Europe, China, India, create a lot of profit, a lot of free cash flow, and world largest, one of the largest company in the world, right? I think finally investing is about company and how they operate. But why India is important is I think we live in a bigger economies, right? So we need to be cognizant, but value can be created by companies. In 30 years, China economy did extremely well, but maybe markets do not do well, right? So it is not a one-to-one correlation. You don't have to see India has to do well only for corporate, right? No, there are phases where India did well, markets did not do well. There are phases where India will do okay, market will do great, or stock specifically things will do well. Any plan people who can invest in SIP but can not bring? No, definitely, sir. 50 lakhs is for PMS. That's by regulation. We do have various way of a service. We have M2W where people who have less than 50 lakhs, we have a very similar solution using mutual fund and index routes to deploy capital and create long value. We'll be very happy to serve you. What's your opinion on EV? I think EV, it's definitely a growth sector, but growth is getting revised downward, right? Recently, we saw every company is revising their capex program downward, the growth projection downward, and that reflecting in Tesla price, which is corrected more than 40 to 50%, right? Clearly, it's a sector of the future, but the question of where the truth lies, right? There is so much of hype out there that in this term, everything will become EV. That's not going to happen. India is a very, very complex country. One of the large PV manufacturers keep talking about in India, we will have EV, we will have ICE, we will have hybrid, we will have CNG, so on and so forth. So I think multiple fuel will operate, but EV will be a very interesting sector to watch out for. We are playing EV in a multiple form. One of the ways, if you look at EV, the vehicle price is 2x of ICE, right? So any company lending to EV, their lending opportunity goes up by 2x, or any company insuring EV product, their insurance premium will be more higher than ICE. So I think there are multiple ways to play EV, or we have played in the past a tech company writing codes for a lot of companies is doing this entire Hiatus, right? View on rating agency, we are very positive. I think we think industrial credit will come back. That should be very positive for rating agency. Two-wheeler space, again, we have been very positive for last 2 years. One of the sustained value, right? If you look at our performance came from a very good exposure to a very high quality, 100% free cash flow generating two-wheeler company was trading at 5-6% dividend yield, and the stock is up close to 100% in last 1 year, right? So clearly, but the story is reasonably played out in our view. Two-wheeler revival is very cyclical. Easy money has been made. I think from here, if the growth sustains, I think there is a decent money. Otherwise, we have to be very mindful on this space. What's your view on cement sector? Again, cement is a very proxy to infra. As long as India growing and this is growing, the demand for cement expected to be good. But again, right, this is a sector where the final product is commodity, even though it's a zone-led or as regional-led sectors. So we have to be mindful on how much you pay, and we don't have any currently exposure in any of our major funds. In small cap, we have one particular idea, but that's again a case specific about particular stock. What's your view on, I've spoken already, the capital is intensive, margins are low, function of government policy. I think broadly, any evolving sector will be mindful to allow the sector to stabilize as, and I thought our objective is to deliver reasonable, sustainable value in the medium term with a low risk. So all this new industry, we will give a little more time to understand the way the balance sheets are evolving, cash flow are evolving, business model is evolving, competition is evolving, which part of the value chain is very sweet. I think then only we'll be able to take a full view, but definitely an industry worth considering, and we are actively, obviously, right, researching, studying, learning trying to attend global conference and try to see what best we can do to our shareholders. Do you think tire company is a good bet for EV? I think yeah, every sector will capture. I think tire. Again, in the last week when I was in conference in chemical, right? Since EV vehicle are heavy on load because of battery, their tire has to be far more robust, and it has to be less noise pollution. So obviously, tire companies will play. Again, it has to be very case specific, right? But broadly, I think tire could be a very interesting play because EV vehicle is heavy and they need less noise. I think tire will play a very critical role. Bearings will play a very critical role, and so on and so forth. How do you think your company stand out from other PMS? Okay, very good question. I think there are 2 to 3 important variables we want to differentiate ourselves. I don't say there's the only way, but this is our way. One, clearly we want to take lower risk. I come from mutual fund background. I work for Fidelity, Reliance, and so on and so forth. A couple of my colleagues have worked in a larger firms outside ithought. So one of the primary belief of ithought is you deliver value, but you deliver value with low risk. And I think all the 4 products sustainably with a beta measure, standard deviation, or any risk metric is lower than the market. So that's point number 1. Point number 2, we actively encourage our investor to be a multiple journey investor, not a single point. We are a D2C brand. We don't distribute through anyone, which is a very unique, right? With a 2,000 crores of AUM in PMS, one of the largest D2C brand in the country. What we do is we actively engage with our client when we find more opportunity in the market, either by writing a shareholder letter or actively pursuing by communicating to the clients in terms of there could be a little more deployment. So I think there are multiple ways we are doing it. And if you look at our product suite is also very wide, very unique. So our TRUBLU is the mega large cap product where we invest only into Nifty 50 stocks as a universe. The finest of Nifty 50 stocks is invested. So the pure large cap is TRUBLU. Then we have Solitaire, another very unique flagship product, close to 1,000 crores of AUM, where we don't have any exposure to banks, right? Again, this is the first multi-cap product in the country without zero exposure to lending companies. Both banks and NBFC with the lending nature is zero exposure, right? Very unique product. We have Vriddhi, which is a private equity type small and mid-cap investing. 2 PMs have a background of private equity, very classical product, but definitely a product for a 5-year horizon. We have done phenomenal track record, the numbers in front of you. And we have multi-asset, which is our 10-year RA product. We have converted into PMS, which invest into all assets. So very unique proposition, and it serves a different need. And to end it, we have a fantastic team of 18 people, right from Mr. Sham, who is the founder, CIO. Then we have 4 portfolio manager. We have 6 analysts, 4 investment strategists, and then execution, right? So a strong team to execute what our endeavor to do it to our shareholders. What's your view on footwear industry? I think they're going through pain. Maybe pain is a little more longer. Valuations are really gone sky high. A couple of companies are executing a new strategy. We have to see. We don't have any exposure in footwear as of now. Food delivery company, do you think can survive? Yeah. I think food delivery company, India is eating a lot. We are eating a lot more, right? That's why I said keep eye on pharma company. As Swiggy and Zomato are rising, we have to be paying a lot more attention to pharma. I think, but otherwise, food is a very difficult business. Even though high on gross margin, it's a very difficult business in terms of continuity, scalability. You have to maintain the quality at multiple time period. But few brands will make it very big. We're just in the beginning of this QSR space. What Nifty 50 TRA TRUBLU? Can you please explain? So TRUBLU is a mega large cap product where we invest only within Nifty 50 stocks, right? So if you look at in the country, every large cap has mid and small cap exposure. They will have micro cap exposure, all that possible. In TRUBLU, you will not find any company beyond Nifty 50. So clearly, true to the evidence, this is the first India's mega large cap product only with Nifty 50 as the outer bound universe. So it gives you a comfort to deploy large capital. So the ideal investor base is who is coming with a 3 to 4 years perspective. India market plus 1 to 2% growth, 30% lower risk, a very high quality large cap portfolio, right? If you're looking at, I think that's what TRUBLU serves you. Hope that answers your questions. I think Tarun looks like we're done. Thanks, sir. Hope we all liked it. Our endeavor is to continue to do every 90 days to give a detailed perspective on how corporate India is firing, where is our fate lies, how we see the numbers, and how we think and operate in the medium term to serve all our investors and prospective clients. Right? That's the whole idea about this session. I think we can end. Thanks for your time, for patient listening. Hope it added a lot of value to you. Continue to support us and do reach out to us. We'll be happy to serve you. Thank you. Tarun, we can close it. Tarun?
Yes, sir. No more questions from YouTube.